Welcome to our fourth quarter market update. I'm Mark Barry. I am the Director of Investment Management here at Centerpoint Advisors, and let's kick things off. So this is going to be a little bit shorter in terms of the video than in the past. We're going to send out the notes pages, which will provide some more in-depth commentary, but this will just be a quick hit, short video. So we're going to discuss asset class performance, review the 2022 markets, and hit on a few other items of note. Asset class performance. So financial markets rallied in the fourth quarter with most assets posting gains. You can see a lot of green in the left-hand column here. The S&P 500 returned 7.5% for the quarter, and the Bloomberg Aggregate Bond Index returned 1.7%. But these positive returns only moderated losses for the year. You had the U.S. equity markets, S&P 500 down 18.1%. Pretty much most sectors negative. Energy equities were really the only strong performer for the year. Value did outperform growth. And then international equities, the MSCI EFA and the MSCI emerging markets down 14.3% and 20.6% for 2022. And actually, they were still down in local currency terms, but a portion of that negative return for U.S. investors, at least, was from the strong U.S. dollar. U.S. dollar was up 9.5%. For the year, so it did impact returns there. And then on the fixed income side, historically bad year. The Bloomberg Aggregate Bond Index finished down 13.1%, its worst calendar year ever. Pretty much all fixed income sectors negative returns. Credit underperformed. You saw corporate bonds, the corporate bond index down 18%, and then here, as you move out of the maturity range, the more negative returns get. Money markets, less than 1 year. Treasury bills were the only positive sector for the year. Commodities did really well. We'll hit on that in a minute, but the Bloomberg Commodity Index was up 19.7% for the year. Gold relatively flat, and as noted, the dollar was up 9.5%. So 2022 market themes. I'd characterize 2022 with three themes: inflation, rates, and recession. Inflation was hotter than expected. Rates rose rapidly as the Federal Reserve tightened monetary policy at the fastest pace in 40 years. And then we got recession fears, which pressured markets as economic data deteriorated. Here you can see this chart. This in green, this was expectations for Federal Reserve rate hikes coming into 2022. Expected, low and slow kind of. Really what we got was a rapid pace of tightening. And then this graphic down below shows kind of the change in narrative over the course of 2022 and one potential path forward in 2023, 2024. To recap the investing environment, bond market volatility was extremely elevated in the year. Actually reached levels we hadn't seen since 2008, 2009 financial crisis. Equity market volatility in pink here actually was relatively muted. Equities, bond yield spiked, but equities kind of grinded lower throughout the year. And you can see here is the inverted bond market volatility index along with the S&P 500, which is in light blue. Yeah, we had some rallies for the S&P 500 throughout the year, but still, the trend was from the top left to the bottom right of the graph. The S&P 500 tracked bond market volatility pretty closely. So, what can you say from that? Well, tightening liquidity was the primary driver of equity returns. And, why another kind of integrating factor? Inflation, right? The correlation between stocks and bonds was extremely high in 2022. You can see in this graph right here, is that what changed here? Well, inflation. We're in an inflationary environment. Now bonds and equities are moving together much more frequently. Commodity markets. Commodities were one of the bright spots in 2022. The Bloomberg Commodity Index is in black here. Prices exploded across the commodity complex in the wake of the Russian invasion of Ukraine. then trended lower throughout the year, but still finished the year higher. It's good, commodity exposure for investors, probably warranted for most, but just you got to be cognizant of the volatility. Here's a chart over the past 2 years of the S&P Oil and Gas Exploration and Production ETF. Energy companies, and yes, it has done quite well over 2 years, but you better be prepared to endure some volatility. You've had a number of 10% plus drawdowns, including 27% and 33% drawdowns. So volatility comes with investing in the space. Now, where do things stand going into 2023? The signals are very polarized right now. You have the U.S. labor market saying everything is appears to be quite good. You actually have 1.7 job openings for every unemployed worker, which indicates the tightest labor market in history. But you also have an inverted treasury yield curve and the deterioration in the leading economic indicator index. Both of those are pretty good recession signals historically. They're both pointing to a recession, whereas the labor market is not at all. So a bit of a back and forth here. We'll see where things stand as we move on into the year. But the Fed does have challenges in terms of engineering a soft landing, where they reduce recession or they reduce inflation with their interest rate hikes, but also don't send the economy into a moderate to deep recession. So some quick hits. Europe has been blessed with a warm winter. A lot of concern coming in terms of the availability of energy, for electricity, industrial production, etc., just because of the conflict in Russia-Ukraine. The warm winter has helped tremendously, so very fortunate in terms of weather. Europe still, over the next few years, might have some issues on the energy front, but crisis avoided for now, which is great. The U.S. Strategic Petroleum Reserve, we have drained that pretty significantly at its lowest level since 1984. And the U.S. has said they're going to buy or refill it at prices below $70 a barrel. Does that provide a bit of a floor for crude? Maybe, but also just from a national security standpoint, I have a bad feeling that the chance that it doesn't get refilled is not immaterial. That can just get kicked down the road, and if we do have a crisis, an actual crisis where the Strategic Petroleum Reserve is necessary and needed, might not be prepared for that. So hopefully they get to refilling that soon. And then the U.S. debt ceiling. We've hit the debt ceiling. The Treasury is taking active measures to shift funds around, so to keep the government operating. Treasury Secretary said they're going to run out of cash essentially in June. I've seen other forecasts that point it towards end of summer, early fall. Whatever it is, as we approach that deadline, markets might get a little jumpy. Both sides of the political aisle really don't seem to have an interest in negotiating right now. They're going to have to as we approach the deadline. So hopefully, as we've seen in the past, that they do come to an agreement at the 11th hour, albeit, but that remains a big political risk domestically for the U.S. and the markets in 2023. And then finally, just a situation going on in Japan. The Bank of Japan is essentially trying to keep yields on their 10-year pegged, even though they're at 4% inflation, right? You've seen the other G7 countries, government bond yields have risen over the last year. Bank of Japan is buying enormous amounts of Japanese government bonds. There's some concern that something, just the structure of the market, something goes wrong here and could have potential, cascading effects on other financial markets, but just something we're monitoring. And then China consumer confidence just might not be all super relevant, but that chart, wow, they did well with COVID, but once that kind of model became untenable, consumer confidence plummeted. We'll see. Markets are expecting Chinese demand growth to snap back pretty quickly, but maybe it's slower than expected. Now, for a quick explainer, I thought would be helpful for investors and of interest, the Dow Jones Industrial Average. Right, it's widely quoted, talked about, headline news in the newspapers, on CNBC, etc. But really, I want to emphasize the Dow isn't just not a useful benchmark for investors. It's not representative of the U.S. economy really, or the U.S. equity market. Why is that? One, it's price weighted, so the weighting of the companies depends on the price per share. So United Health Group has the highest price per share of the 30 companies in the Dow at $485 and change. That means it has the highest weight in the index. Goldman Sachs Group, second largest component of the index. Why? Because the share price is the second highest at $349. By market cap, which the S&P 500 is weighted by, it's actually the 69th largest holding in the S&P 500, but it's number 2 in the Dow. So, it's historical, it's famous, but investors, it's just not a relevant benchmark for investors. That is it for our fourth quarter market update. As always, please feel free to reach out to either myself or JD Wolfsberg. Happy to answer any questions you may have on the markets, discuss investments, etc. So please feel free to do so. We will see you in the spring for our first quarter market update. So enjoy the rest of the winter. Thank you.